In the last 4 years, COMEX silver inventories have dropped from 400 million ounces to 250 million. That's a 37% decline. Meanwhile, industrial demand is consuming 600 million ounces per year. At current depletion rates, COMEX hits critical levels by late 2026. But here's what makes this interesting. Most market analysts are still pricing silver like it's 2015. They're missing 3 structural changes that have never existed simultaneously in commodity markets, and the data suggests we're watching a supply-demand imbalance play out in real time. I'm going to show you the numbers, walk through what could go right and wrong with this thesis, and give you a framework to evaluate it yourself. Let's start with the math that doesn't add up. Here's global silver production: 830 million ounces annually. That number peaked in 2016 at 900 million and has been declining since. Why? Because 70% of silver comes as a byproduct of copper, lead, and zinc mining. When those metals aren't profitable, you don't get the silver either. Now here's industrial demand. Solar panels, 150 million ounces. Electronics, 240 million ounces. EVs and 5G, 60 million ounces. Medical, water purification, other, 150 million ounces. Total 600 million ounces per year. Then you have 700 million ounces locked in ETFs like SLV and PSLV. That's silver that's been removed from circulation, and historically doesn't come back to market unless prices spike dramatically. Add jewelry demand from India and China, coins and bars from retail investors, and you're looking at total annual demand around 1 billion ounces. Production, 830 million. Demand, 1 billion plus. We've been running a structural deficit for 5 consecutive years. So where's the missing silver coming from? Above ground stockpiles. Inventories that have been accumulated over decades are being drawn down to fill the gap. Now, before you assume this immediately means prices explode, let me show you why timing matters and why this could play out several different ways. Everyone who's studied silver knows about 1980. The Hunt brothers, Texas billionaires, bought 100 million ounces using futures contracts and leverage. Silver went from $6 to $50 in 1 year. Then the CFTC changed the rules. The Fed raised rates to 20%, and the Hunts were forced to liquidate. Silver crashed from $50 to $10 in 8 weeks. So here's the question. Could that happen again? Could regulators step in and break any future silver squeeze like they did in 1980? The answer is probably not, and here's why. Change number 1. No government stockpiles. In 1980, the U.S. strategic stockpile held billions of ounces accumulated since World War II. When prices spiked, the government sold. That inventory flooded the market and broke the squeeze. Today, that stockpile is empty, sold off through the 1990s and 2000s. India used to export silver. Now they import 200 million ounces annually for jewelry and temples. That silver doesn't come back. China went from exporter to massive importer. There are no government reserves left to dump on the market. Change number 2. Industrial demand is non-negotiable. In 1980, industrial silver demand was minimal. Photography, some electronics. When prices spiked, users could cut back or substitute. Today, solar panel production alone consumes 150 million ounces per year. That's up from 50 million in 2015. You cannot make a solar panel without silver. There's no substitute at scale that maintains efficiency. Electric vehicles use about an ounce of silver each in electrical systems. Global EV production is projected to hit 30 million units by 2030. If silver prices spike, solar manufacturers and EV producers can't just stop buying. Their entire supply chain shuts down. This creates inelastic demand that didn't exist in 1980. Change number 3. Distributed buyers, not concentrated manipulation. The Hunt brothers were 2 people using leverage. Regulators could target them specifically, change the rules, and force liquidation. Today, 700 million ounces are held by ETFs owned by millions of investors across dozens of countries. Retail investors demonstrated in 2021 they could coordinate buying. They crashed bullion dealer websites. Physical premiums hit $10 over spot. You can't change the rules to force millions of distributed investors to sell. You can't shut down industrial demand. The 1980 playbook doesn't work when the buying is structural rather than speculative. But here's where it gets interesting. In March 2020, when silver crashed to $12, the largest silver ETF, SLV, held 480 million ounces. Then retail investors started buying. By February 2021, SLV held 670 million ounces. That's 190 million ounces of physical silver purchased and delivered to vaults in just 11 months. To put that in perspective, 190 million ounces is 23% of annual global mine production. Now here's the critical question. Where did that silver come from? It came from refiners, from dealers, from above-ground stocks sitting in London vaults and Swiss banks. And once it went into the ETF, it effectively left the available supply. Because here's how ETFs work. When people sell shares, the ETF can deliver either cash or physical metal. Almost always they deliver cash. The silver stays in the vault. Look what happened in 2022. Silver prices pulled back. SLV holdings dropped from 670 million to 550 million ounces. Everyone said, see, the squeeze failed. People are selling. But look at other ETFs. PSLV grew from 110 million to 150 million ounces during the same period. Total global ETF holdings didn't drop. They stayed around 700 million ounces. The silver just moved between funds. Every price spike, more silver flows into ETFs. And it doesn't come back out. 2008-2011, 400 million ounces accumulated. 2021, another 200 million. This is a one-way ratchet. Each cycle, more silver gets permanently removed from the pool available for industrial use. And you can see it in the COMEX data. Registered inventory, silver available for delivery, has dropped from 400 million ounces in 2020 to 250 million today. If this depletion continues at current rates, COMEX registered inventory drops below 100 million ounces by late 2026. That's when things get interesting. So we've established there's a structural deficit. The question is, how does the market respond? I'm going to walk through 3 scenarios, not because I know which one will happen. Nobody does. But because understanding the range of possibilities helps you make better decisions. Scenario 1, gradual repricing. In this scenario, the market slowly recognizes the deficit. Industrial users start competing more aggressively for supply. Prices gradually rise from $30 to $50, then $70 over 2 to 3 years. This is similar to what happened with palladium from 2016 to 2020. Structural deficit in automotive catalysts, gradual repricing, no dramatic crash. I'd put this around 40% probability. It's the rational market scenario where price discovery happens smoothly. Scenario 2, supply shock event. In this scenario, a trigger event causes acute shortage. Maybe a major mine closes. Maybe industrial users panic buy. Maybe retail coordination happens again, but larger. Silver spikes from $30 to $100 plus over a few months. Premiums on physical metal hit $30-$40 over spot. Total chaos in the dealer market. Then it crashes back, but not to $30. It settles around $60-$80 because the fundamental shortage hasn't been resolved. New mines take years to develop. Industrial demand hasn't disappeared. I'd put this around 35% probability. History shows commodity markets often respond to supply deficits with volatility rather than smooth adjustment. Scenario 3, system breakdown. This is the most dramatic scenario. The gap between paper silver on COMEX and physical silver in your hand becomes so wide that the pricing system breaks. You can buy a futures contract at $60, but physical silver is trading at $120 in the dealer market. Because there isn't enough available, COMEX implements emergency measures. Maybe forced cash settlement. Maybe trading halts. Governments implement export restrictions and price controls. This is the scenario that gets the most attention online, but it's probably the least likely. Maybe 15-20% probability. Why? Because markets are more resilient than people think. Price controls usually fail, but they buy time. New supply eventually comes online. Higher prices incentivize recycling. The remaining 5 to 10%, silver just stays around 30. The deficit continues, but somehow the market muddles through. Inventories deplete but never hit zero. It's boring and frustrating, but it's possible. The point is, even the worst case for silver bulls, gradual repricing to 50-70, still represents significant upside from current levels. But it also means you need to think about risk management and position sizing, not just upside potential. If you're considering a position in silver based on this supply deficit thesis, here's how to think about it intelligently. Step 1. Separate conviction from position size. You might be 80% convinced the deficit is real. That doesn't mean 80% of your portfolio should be in silver. Conservative approach, 2-5% of portfolio. This gives you meaningful exposure if you're right, but doesn't wreck you if you're wrong. Aggressive approach, 10-15% if you have high conviction and can handle volatility. Anything above 20% means you're speculating, not investing. Even if you're right about the thesis, your timing could be off by years. Step 2. Physical versus paper. Physical silver, coins, bars, pros, you own it. No counterparty risk. Cons, storage costs. Premiums over spot, less liquid. Paper silver, ETFs, mining stocks, pros, liquid. Lower costs, easy to trade. Cons, counterparty risk, doesn't give you actual metal in a crisis. My take, if you're positioning for a supply crisis, having some physical makes sense. But don't pay $15 premiums over spot right now, shop around. Consider larger bars instead of coins if you're buying meaningful amounts. For the bulk of your position, ETFs like PSLV, which allows redemption in physical, might make more sense than SLV. Step 3. Know what you're watching. If you take a position, don't just buy and forget. Monitor these metrics. COMEX registered inventory, updated weekly. If it drops below 150 million ounces, that's your early warning sign. ETF flows. Are SLV and PSLV seeing major inflows? That's demand pressure. Industrial demand data, solar panel production, EV sales. This tells you if demand is accelerating. Mining production. Are new mines coming online? That could ease the deficit. Sources. COMEX publishes inventory data, ETF holdings are public. CPM Group and Silver Institute publish annual supply-demand reports. Step 4. Have an exit strategy. This is what nobody talks about. Everyone focuses on entry. Nobody plans the exit. Set criteria before you invest. If silver hits $75, I sell 50% to lock in gains. If new mine production increases 15%, thesis is weakened. If I'm down 30%, I reassess the thesis entirely. The point is, you need rules. Because when silver is spiking to $90 and everyone online is screaming $200 next week, you need predetermined criteria to avoid emotional decisions. Step 5. Understand what could prove you wrong. Here's what could break this thesis. Major recycling breakthrough. If someone figures out how to economically recycle silver from electronics at scale, that's 200+ million ounces of new supply. Substitution in solar. Copper or aluminum could replace silver in photovoltaics if efficiency losses are acceptable. Demand collapse. Global recession kills EV sales and solar installation. Industrial demand drops 20%. New megamine discoveries. Unlikely but possible. One massive new deposit could ease supply concerns. Central bank intervention. Governments could release strategic reserves we don't know about or restrict industrial use. I don't think any of these are likely in the next 2-3 years. But intellectual honesty requires acknowledging what would prove this thesis wrong. So here's where we are. The data shows a structural deficit. Production of 830 million ounces. Industrial demand of 600 million plus investment demand. 5 years of inventory drawdowns. COMEX registered inventory down 37%. This could play out as gradual repricing to $50-$70. It could be a supply shock that spikes to 100+, then settles higher. It could even be a system breakdown, though that's the least likely. The question isn't will silver go up? The question is, given the data, what's a smart way to position for a range of possible outcomes? Appropriate position sizing, mix of physical and paper, clear metrics to monitor, predetermined exit criteria, understanding what could prove you wrong. That's how you think about this intelligently rather than emotionally. I've put together a simple tracking spreadsheet with the key metrics we discussed. COMEX inventory, ETF flows, production data, with links to where you can find updated numbers. It's free. Link in the description. Look, I don't know if silver hits $50 next year or in 5 years. Nobody does. But I do know that 1 billion ounces of annual demand hitting 830 million ounces of production is a math problem, not a political opinion. And math problems eventually resolve themselves. The question is whether you'll have positioned intelligently before they do.